So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Sam Bates. Sam is the founder and CEO of Bates Capital Group. He is also a principal and advisory board member of Systematic Capital. Sam started his real estate journey in 2009 and has been directly involved in the acquisition or development, reposition, disposition, asset management, and strategic planning of over $200 million in assets. His portfolio currently has 1,035 multifamily units in Texas and the Southeast. They have over 1,000 units in their development pipeline. Sam, welcome.
Thank you for having me. I look forward to talking to you and sharing some insight with your listeners.
Absolutely. We're very excited. Do want to mention that Sam is another member of Raise Masters. You guys are probably sick to death of me talking about Raise Masters, but I'll never stop. So
that's a great program. It's a great community, and you meet some phenomenal guests and people. And I think that's been the most value add from it, is just meeting people like you. And I could go on and on with just the high quality and high caliber people that are in Raise Masters.
Absolutely. And all of us were kind of part of the initial crew, which was a smaller group. And so, we kind of became really tight knit, as, obviously all the other groups too as well. But when it's a little bit more, a little smaller, you get a little more intimate, which is fun. However, let's get into the fun stuff. So like we do with all of our guests, Sam, give us kind of, the Reader's Digest version of how you got into real estate.
Yeah, I was undergrad finance. I actually thought I was going to get my master's in real estate, but in between undergrad and grad school, I had an internship at a financial institution, and it kind of mesmerized me. And I saw the glitz and glamour, and the stock market at that time was just skyrocketing. This was back in 2005. So I decided to stay at the company that I interned with and started working full time. And I was an investment analyst and put together stock portfolios and mutual funds and different things that the advisors would sell to clients. And I really enjoyed the job, but I decided to go back to grad school. At that point, I thought I was going to do financial planning for the rest of my life. So I got an MBA instead of real estate, and then a master's in personal financial planning. And during that time, the market crashed. And I realized no matter what I was picking, no matter what the advisor was suggesting, there's no control over that. Like, I can't control the price of Coke, because if their CEO does something, or an event like the Russia-Ukraine war happens, it's going to affect the pricing. So I kind of diverted and went the consulting route for a while, and I quickly realized I needed to be my own boss. Some people are great W-2 employees. I learned quickly I wasn't. And I went from, research and talking to investors and clients to basically sitting behind a cubicle for 10, 12, 15 hours a day. And it quickly made me kind of reevaluate my career choice and career path. And it led me back to real estate. And I started investing as a limited partner, actually, in some apartment deals and a hotel syndication. Then did single family. Then I guess in 2013, I decided I needed to be doing multifamily and then get on the GP side. And really since 2016, I've been a GP, and I've been a GP on 14 deals, about to launch 5 to 6 more deals, all development. And that's kind of where we're at now. Like you said, I've focused in Texas and the Southeast. The development perspective, specifically just Texas, but acquisitions will look kind of in the Sun Belt and a few other markets.
Awesome. I love it. What a great story. the crash comes and you're like, oh, cool. I'm glad I picked the
Yeah,
worst possible major I could be in right now.
exactly. And like, luckily, I just started out in my career, but I had actually been investing in mutual funds since high school. So I saw my portfolio drop. I saw our grandpa's portfolio drop, other clients, and I was like, you can't control the timing. And even if the market is 8% annualized or whatever they say, if you have a year that you're losing 30 to 40%, that kills your returns for the next decade. So, or potential decade.
Absolutely. It's so true. And you know what? I was a stockbroker for a few years, so I can definitely attest to it. And you know what? Listen, we all make money in a bull market, right? But you know, when economic times get tough, it's about finding those risk-adjusted assets that can still make the returns we want. And subjectively, I think it's real estate. So I love that. You know, your strategy's kind of changed. Obviously, have you always been in those markets since you started?
Yeah, I mean, I've always been in Texas, and we've kind of carved a niche because we aren't Trammell Crow or JPI or any of the large players. So we've built primarily in secondary and tertiary markets, and we go in the path of progress, and it's been great for us. Some of the markets that we've developed in, I mean, one specifically, it was so small there wasn't data. And typically we go with data, we go with again, third-party reports showing supply demand characteristics. But in this particular one, the population was 3,000 people and it just didn't work. But I mean, we've exited, we almost 5x our money. Is like a
Holy cow.
4.82% or equity multiple. So it's been great. But yeah, we've always focused in Texas, and then just from a competitive nature and where people are moving, that's forced us in to look at other markets. And I've assets in 3 other states, but I still focus primarily in DFW and the Texas market.
Love it. Great market. Obviously, a ton of real estate to work with, pun intended. But I want to talk about this deal. So you built in a town of 3,000 people. What kind of pushed you there? What was the strategy there?
This was actually one of our smaller deals. So we got some land right next to a high school, and the land basis was really low. There was no inventory. It's about 30 minutes northwest of Fort Worth. So it was in the path of progress and people were going there, but it just hadn't really hit. And I mean, most people, if you talk to them DFW, they don't even know where the location is. Um, but we felt like all we needed to do was fill 48 units. And it started off a little bit slow, but we leased it up probably in 7 to 9 months. So it filled up quicker than honestly I was anticipating. And our break even with a land price so low, and we import most of our building products from Asia, our break even was like 45 to 50% occupancy. So we knew we could do it. We just didn't know exactly how much we could get occupied. And then luckily over the last couple of years, rents have increased. So we started off at like, and they were all basically townhomes. So 3-bed, two or 2.5 bath. So it's people that are in between apartments and houses, and they want a nice place. They want to be proud of where they're living. So we were able to push rents $400 to $500 from initial start of the lease to the end of the lease up and when we sold.
Wow. That's awesome. What a great deal. And obviously some risk involved, but when you take that risk, you know, on the other end is a big reward, usually, if you do it correctly, which you guys did. So that's awesome. So let's get into development now. You know, we mentioned in the intro, you got about 1,000 units in the pipeline. Sounds like about 4 or 5 deals. Are you guys vertically integrated with construction? Is this all in-house?
Yeah, this is all in-house except one of the deals, but we are vertically integrated. I'm also an owner in a construction company. So all the developments we've done it in-house, and we've built out a team of about 40 to 50 over the last couple of years, where we have engineering department, we have legal department, we have now essentially FP&A. So we have all the pieces together. My partner, he's been in the business 20 to 30 years, so he has relations with all the subs, and it's just helped us tremendously. Like I was saying, we import from China. That was a relationship my other partner had from a colleague / friend, and we've cultivated that and actually went to China. So we're completely vertically integrated, except from the property management perspective, we still outsource that.
Awesome. I love it. And subjectively, I think obviously if you're going to do development, I think that construction is the first thing you should bring in-house. So let's talk about these deals. Obviously, we're kind of talking offline. Right now, you don't love asset prices, neither do I, which is kind of pushing you away from acquiring already built. So what markets are you in, and what is it that you got? What strategy are you guys using here in these developments? Are you building A, B? Let's get into it.
They're all DFW except one, and the other one's in Austin. The one in Austin, it's in a opportunity zone. It's going to be workforce housing. It'll be A, but probably lower A than like your A+ urban core type asset. And then we have a development in Denton, which is 30 miles north of Dallas and Fort Worth. It kind of converges together. That's going to be pretty much an A++. We're going to have a significant dollar or price per unit prospect, but we think we can, or cost, but we're going to be able to get hopefully $3,500 a month in rent. And for an apartment in Texas, that's significant. So we're going to have that. Then we have a few other developments more in secondary and tertiary markets. One's a student housing build, and then one's in a town that was pretty much land probably 5-10 years ago. They built this school in 2018, and it's right along one of the tollways into Fort Worth. So it's starting to grow. So those are going to be not quite as high end, but they're still probably A-. Like they'll have quartz counters, vinyl plank flooring. I mean, it'll be stainless steel. It'll be a nice place to live with good amenities.
Awesome. I love that. So kind of a mix there. Are you just using same like broker relationships, or how are you finding these different lands and land pieces and deciding what needs to go where?
Yeah, it's all kind of come from different sources. The student housing development was listed on the MLS, and a single family realtor was selling it and had it completely listed wrong. So we were able to rezone it pretty easily with the city, and there's a demand in that market. So that was one way. One came, actually, we're partnering with with a buyer of the land. He doesn't know how to develop. He doesn't know how to raise capital. So we're coming in and basically putting all the pieces together. One was just a broker deal. And then another one of my partners got through just relationships he's had for 10, 20 years.
Wow. That's awesome. So just an amalgamation of different things kind of coming together. So are you finding, a lot of hurdles and red tape working with the cities, getting permitting and things like that?
Yeah. For a little while, we kind of course corrected because there was so much red tape with cities. We started building right outside the city, so we only had to deal with the county. But when we build in the city, we're dealing with the city. In Texas, sometimes you have to deal with like an ETJ or some type of district. So it is cumbersome, and they're getting more and more difficult to deal with. And a lot of the cities are wanting to reduce their multifamily footprint, and it's hard to get land zoned. And one of the big value adds we do is taking either land that's zoned for something else or just raw land that's not zoned for multifamily and going through the entitlement process. So it is a little bit of a risk, but we always put our capital at risk. We don't take investor money to do that. And then once it's entitled, we can bring in investors and have a lot more comfort that we're going to be closing without putting their money at risk and basically de-risking the deal for them.
Awesome. I love that. I was just going to ask, from the investor side, what does that look like? So once they are in, or, you have it entitled, what was that process like in terms of building a list of people who are willing to take on this risk? And, what does that process look like throughout it to, keep them in the loop and understanding what's going on?
It is a lot different from an acquisition. And initially we were, let me step back. The first 3 to 4 deals we ever did were development. So we were raising funds from people that knew us, either business relationships we'd had, friends, a few family members. So they had a trust with us. And then once we produced, it just led to more and more. But it is a certain investor, especially I think 5-6 years ago when we started, because you always hear that development's risky. It takes a while to cash flow. And back then you could buy an asset for, in some locations, we bought it 8 cap in
Wow.
18. So in some locations you're paying anywhere from a 5 to 8 cap. So they a lot of people frowned on development. So it took a special investor, but over time, I think they've just seen our success and seen how much we've developed, that now people that have invested in our acquisitions have either come to the conclusion that we know what we're doing, or the market has indicated that. Like, I've talked to one of my investors pretty often and pretty frequently, and she's only invested in acquisitions, and now she's on board with moving over to developments because she thinks it's less risky at this point in the cycle. And I could argue it's definitely less risky, especially if you take entitled land that's already zoned for multifamily. But we always communicate with our investors on at least a monthly basis on acquisitions. And we were doing that with developments, but some months nothing would happen. And now we've scaled that back to quarterly, or just kind of telling them when important deadlines or events were happening to just keep them abreast of all the issues.
I love that. That's awesome. Over communication is definitely the key. Also, one thing I'm starting to notice with, discussing with other developers is that, the savvy investors are starting to understand that that's where the yield is. And like you mentioned, understanding that it is potentially less risky, on a risk adjusted basis compared to some things. You can definitely make an argument that it's less risky. And so it's not taking as much to kind of bring investors over, find investors who are willing, to invest in that development and that whole process. So are you guys, you mentioned that you go to China for all your supplies and all the different things like that. Are you having any issues with, supply chain and pricing and anything like that?
Yeah, luckily, I think it was just in our development cycle, we stopped importing right before the trade war started, because we have about a 18,000 square foot warehouse, and we'd built up a lot of supply and inventory. But now we're going to start re-importing back in, and prices have shot up significantly. Like, we used to be able to get nice vinyl plank flooring for 50 cents a square foot. It's more than doubled that now.
Wow.
We were getting quartz, like nice quartz counters, for anywhere from $11 to $15 per square foot. You can't get granite for anywhere close to that. And now pricing's completely changed. So our build cost has shot up significantly. But if you look 4 years ago, rents have shot up significantly as well. So it's helping offset the cost, but at least where we're looking, land has shot up as well. So we're being more particular on what we're buying it per unit, and to make sure those economics work.
I love it. So kind of along those lines and how we mentioned earlier, less risky, what are some points, for the argument that development is less risky right now?
Well, just from a high level perspective, a lot of syndication groups and just investors in general are going after 1960s, 1970s, even 1980s. If you think about a 1980 product is now 42 years old. And when you're buying in Texas and the Southeast and some other markets, anywhere from a 2.5 to probably a 3.5 cap, if you mess up on your underwriting, if you undercapitalize your renovations or a pipe burst or foundation issues, which has happened. Like I've walked some deals the last few years that were horribly undercapitalized, and the only reason, or they're essentially having to sell, and the only reason they're making a profit is because cap rate compression. So, or maybe not even making a profit, because I know people who've invested in deals that get out and have lost money the last year or two, which baffles me. But to go back to your question, if you take it through entitlements or you buy an entitled piece of land, you can build X number of units, it's zoned for retail, commercial, multifamily, whatever it is. Yes, there's risk on the pricing increasing, like lumber or OSB. I mean, OSB at one point shot up from $11 to $50. So that's a huge difference. But the way we structure and the way we de-risk it is we've always done, since we do everything in-house, we've always done a fixed contract. And if we go over, we eat that. So our investors are protected that way. And we've always budgeted where there's enough room where we haven't had to. I mean, one project we had to bring in more money from our own pockets just because the city negotiated some talking points that they said they were going to do, and they backed out of it. But the investors' capital wasn't at risk, and it might take a little while. Supply chain issues have pushed timelines, but when you're finished, so far in this cycle, rents have went up, cap rates have compressed. You're getting a brand new asset with usually higher quality tenants that you'd get in a 1970s product, and you're getting a property that should be maintenance free or minimal maintenance issues for a very long time. So you might not get the returns that we were getting 3, 5, and people were getting 7 years ago on development, but you're still going to get a very solid asset that is going to produce quality returns.
Absolutely. I couldn't agree more. So what exit strategy are you guys, do you set it up to stabilize it, get it going, and then look to exit? What are some of your strategies there?
It honestly depends on the deal, but typically we've built it, stabilized it, refinance, pull all the investor capital out, and then just cash flow it. The project where we almost 5x our money, it was more of a merchant development, and we did that because it was us and one partner. So and that partner, his family has invested with us a significant number of times, and he actually now works for us and is a partner in a company. And there was just flexibility where we saw we could get a fantastic return, so we just sold it. But ideally, we want to create cash flow. We want to take advantage of taxes and cost seg for all the depreciation. So we pitched our investors usually a 5 to 10 year hold. We've learned the further out we go, the less likely they're going to invest just because of uncertainty. But like the Austin project's in an opportunity zone, and to take full advantage of the opportunity zone, we need to stay in for 10 years. So realistically, we're going to stay in for 10 years. And that's what
Wow.
we'll pitch to them.
That's wild, thinking about a 10-year plan.
Yeah, I know. Now thinking about it, that's 2032. That's a long ways in the future.
Long ways in the future. A lot can happen overnight, let alone 10 years. But that's awesome. That's great that you guys have all those different plans in place, right? Because you never know what's going to happen, at the end, and when the development, is finally finished. But subjectively, I like cash flow as well. So I really like the idea of, lease up, get it going, get it operating, and then, refinance or get the capital out and keep going. That's personally my favorite exit strategy, but certainly with cap rates compressing, I'm not sure if they can compress any further. So the refinance strategy is
Yeah,
the biggest one that I'm keeping an eye on for sure.
yeah, definitely. Cap rates might not compress anymore, but since the government's created $8 trillion or $10 trillion over the last couple of years, and like you were saying earlier, everybody's searching for yield. I could easily make an argument that they're going to stay at this rate or get potentially even lower.
I know, it's insane. Are you guys bringing in any institutional money for any of
We
your deals?
haven't yet, but for this Austin development, we might. It's going to be a large project, and we would prefer to bring in one institutional player. And I've started making contacts with a lot of institutions, but we just haven't signed on the dotted line.
Are you doing like family offices, private equity? What are you?
Yeah, family offices, placement agents, some debt funds, some insurance companies, investment banks that have those type of relationships.
Oh, wow. So you're hitting them all. Nice.
Yeah, just trying to dip our toes in the water. And I've heard horror stories of institutional capital, so we're cautiously moving forward, but hopefully I won't have any of those horror stories.
Absolutely. I mean, listen, there's good and bad everywhere you go.
Yeah.
They just typically like to have a little bit more control from what I understand. So kind of pros and cons. Awesome. Well, unfortunately, we are coming up on time here, but I do have 5 questions I asked all of my guests. It's the final 5. First question, what's the best advice you've gotten from a mentor?
That's actually really, there's so much advice. I think, and I don't know even if it was my mentor, but better the quote about basically getting it out there and doing it is better than perfect. And I'm a perfectionist, and I'll like analyze things to for perpetuity. And I think just getting out a product and just like stepping out and doing it is so beneficial. And like all the projects I was doing early on didn't go 100% plan. There was always hiccups. And if I would have let that impact me in the single family space, I would have never got into the multifamily space or grew.
Awesome. I love that. I think there's a saying that's like, you don't have to be great to start. You just have to start to be great, which I really like. So, yeah, love that. What is it about your career that makes you feel like you're fulfilling your why?
I'm not sure.
Don't fall.
Buckled. I love my career choice for a couple of reasons. Growing up, I grew up in a farming community, very blue collar. The only way I thought I could help people was being in medicine. And I've learned clearly that's not the case. But like talking to investors, and most of our investors are, some are accredited, some aren't. Most of them don't have millions of dollars. So it's great to help them achieve their goals and dreams and help them buy a car or retirement or college education or whatever they have that they want to reach. And also, I've been blessed that real estate is a lucrative career, and it can be. And I've been able to give back in so many different ways to charities and organizations that I hold near and dear to my heart that I never thought I'd have been able to in the past.
Wow. I love that. That's so awesome. Giving back, freedom, all of it. Incredible. Favorite non-real estate or investment related book?
I read a lot of like personal development and probably Jack Canfield's The Success Principles. I read that, I don't know, 5 years ago or so, but it just had a massive impact. And I've read it a couple times since, or listened to it on audiobook because it's a very thick book. But if you take a lot of those lessons and apply it, you're going to be successful. And I think it's part of it's just treating people well, follow up, a lot of things that we don't think about, and even just also psyche and mindset. Like, I know my mind has shifted greatly over the last 6 or 7 years. A lot of it's from books and just experience and gaining the confidence after you do something.
Absolutely. I couldn't agree more. If you could have any superpower, what would it be?
Oh, that's a good question. At this point, I would say teleport anywhere, anytime.
I love it. Sure, reduce our business expenses. Oh,
Yeah,
I need to go look at this. I
exactly.
need to go look at this deal. Boom, there.
Yeah,
I love
yeah.
it.
I hadn't even thought about that, but I was just thinking about for travel and other purposes.
Absolutely. That would be so nice. Just not having to deal with traffic anymore. Oh, that would be so beautiful.
Yeah.
I like to think I'm a calm person, but when it comes to driving, road rage is a real thing.
Yeah, I was up in the mountains for like 3 months, and I just got back to Dallas a couple weeks ago. And the first hour or hour out, I noticed traffic just starting to speed up and my heart increased. And it's like, yeah, I don't miss this at all.
Oh man, I don't blame you. Awesome. What's the best way for people to get a hold of you and learn more?
Yeah, definitely. You can reach me through social media or go to my website. It's batescapitalgroup.com, and it has all my information. And we have some free literature that you can get to learn how to invest like the top 1%.
I love it. Sam, thank you so much for your time. I really appreciate it.
Yeah, Johnny, it was great to see you again and talk to you. And thank you for having me on.
Always, you're the man. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.